Hey guys, so you're welcome to the third course in this Crypto Basics program. So in this course, we want to talk about the difference between sports trading and futures trading. What exactly is sports trading? Sports trading is basically the process of buying and selling of cryptocurrencies. It's just crypto trading, okay? And why we call it sports trading is simply because it is a cryptocurrency that you can buy and own. So if you buy a cryptocurrency, you own it. Sports trading allows you to be able to withdraw the cryptocurrency from one platform to the other because you own it. You buy it and you own it and you get it at the spot, just as the name implies. Now, spot trading is also, like, let's say for instance, maybe you are buying a coin on decentralized exchange, you swapping one cryptocurrency to the other. That is still spot trading because it gives you the ability to own that coin. Like, you can withdraw this coin, you can move it from one platform to the other. And why do we trade cryptocurrencies? We trade cryptocurrencies because we want to make money off the volatility. What I mean of the volatility is that the cryptocurrencies are volatile in nature. It means the price usually goes up and goes down, and you have to take advantage of that by buying a particular cryptocurrency when the price is low and aiming to sell it when the price has appreciated and make profits. Can you lose money while trading? Yes, of course. You can lose money while trading. How? You lose money when you have bought a coin and instead of the price of the coin to go up, it rather drops. If the price decreases, that is how you lose money. But not like if the price decreases, you just lose money. If the price decreases and you decide to sell it at that point when the price has decreased, that is when you've lost. But if the price has decreased and you prefer holding it, expecting the price to go up until you sell, you have not lost anything, right? You are just simply holding on to it, waiting for the price to recover, then maybe you sell and make profit. Excuse me. So, but if the price has dropped and then you have sold it when the price has dropped, if the price recovers, in as much as you no longer own the coin, in as much as you have sold it as the price has dropped, you are not going to profit when the price has recovers. If you did not get that, you have to listen to it again. So now the difference between spots and futures. So now what is futures? Futures has a lot of names. You can call it margin, you can call it derivative, you can call it leverage trading, you can call it futures. It has about 4 names or even more. And how it works is, just as the name implies, you are basically speculating or kind of betting on the future price of a particular cryptocurrency. You are betting on the future price of a particular cryptocurrency. And what this simply means, or why we also call it derivative, is because it is kind of a contract. You know what contract means? So it is kind of a contract that derives its price from actual cryptocurrencies. So we have thousands of cryptocurrencies: Bitcoin, Ethereum, XRP, Litecoin, Dogecoin. We have a lot of them. These are cryptocurrencies that you can buy on spot, maybe on decentralized or centralized exchange, and you own it in your wallet. Then when it comes to futures, futures doesn't give you this ability to own these coins. It just gives you the platform for you to bet. I don't like using the word bet. It gives you the platform for you to speculate, like you enter a trade, speculating that, okay, this coin is going to go up. And if that happens, you're actually going to make profit. And if you say this coin is going to go up and you buy or you long it, if that happens, if you say it's going to go up but the price goes down, you will lose money. And also, if you want to short it, that is, you have speculated that the price is going to drop and then you decide to short it. If you short it and the price goes down, you are going to make money while the price is going down. And if you are shorting and the price goes up instead, you are going to lose money as the price is going up. So futures allows you to make money both in maybe uptrend market or downtrend market. That is, if the price of a coin is going up or if the price of the coin is going down, depending on what direction of the markets you are trading. So we have shorting, also known as selling. It means speculating a price of a coin to go down, and you enter a trade, and if it goes down, you profit. But while shorting or selling, if the price goes down, you are going to lose money. Sorry, if the price goes up, because you were shorting or selling, you are actually going to lose if the price goes up. You only profit if the price goes down. So while buying or longing, buying and longing is just the same way you trade on spots, because on spots it is known that you only buy low and sell high. But in futures, you buy low and sell high. Yes, you buy low and sell high. We call it longing or buying. Or you short or sell. If you short or sell, you have to short when the price is high, and you expect to make profit when the price is low. So for example, the current price of Bitcoin is around maybe $93,000, for example, and you believe that there is possibility for the price to drop to maybe $85,000, and then you short it from $93,000, and as you have shorted it, when the price drops, and luckily drops to maybe 85k or 87, whatsoever price lower than how much you shorted, that's when you are going to profit. So we have benefit of both sports trading and futures trading. The benefits of sports is that it is not as risky. Sports trading is not really risky, and yes, it's not really risky. But futures trading is kind of a two-edged sword. It is risky and it's also profitable. It is profitable if you are lucky. It is profitable if you are good at risk management. It is possible if you accept that you can lose and be ready to cut your losses early enough when things go south. Okay? And it's also profitable when you are not greedy. And it's very dangerous when you are greedy, you are bad with risk management, and it is very risky when you expose so much of your capital to the market by risking almost everything. So now, I think, so like I said earlier, it is a contract that derives its price from actual cryptocurrencies. So on futures, let's say for instance, you want to trade a coin like LTC, which is short for Litecoin, and as you have maybe long LTC, since you are not having access to actual LTC, you are note that futures trading is derivative that derive its price, a derivative contract which derives its price from actual cryptocurrency. So as you have bought or maybe long or short, you cannot withdraw this LTC because you don't own it. It is this exchange that you are trading that is offering you this platform to speculate the price movements. Trade it. You only trade the price, but don't have access to the coin. So you cannot move it from one wallet to the other, from one exchange to the other. It is limited to that exchange that you are trading. So another thing, another advantage, I don't know, yes, that is an advantage. Another advantage of futures trading is that it gives you the leverage to trade beyond your capital, or I would say it allows you to borrow money. Okay, so let's say you have a capital of $50, and out of the $50 you decide to trade futures, and in futures trading you want to use maybe 10x leverage to trade. So 10x leverage now allows you to trade with that your $550. If you are using 10x leverage, it means your capital is going to be multiplied by 10. And then when you enter a trade, you are trading as someone using $500, right? Because it borrows you money for you to trade. That is the leverage beyond your capital. And if you make profits, everything is yours. And if you lose, there are chances that you are basically going to lose more than you could lose if you were trading spots. So it is more like your capital in futures trading, your capital serves as a collateral. So it serves as a collateral, meaning you have $50, that is your collateral, and that collateral enables you to have access to as much as possible. Some exchanges offers up to 100x. So let's say, for instance, your $50 and you want to use as much as, with your $50 you want to use as much as 20x. 20x is just like 20 times your capital. If your capital is $50, if you multiply 20x by $50, that is $1,000. So in as much as your capital is now enhanced, your profit is also enhanced, right? And your losses is also enhanced. So on the flip side, or I would say the negative aspect of it, is that this money that you've borrowed, if you decide to use higher leverage, it means this exchange has given you a lot of money. And now your losses also comes in multiples. What I mean your losses comes in multiples is that whatever leverage you are using, if the market drops by 1%, that 1% drop in the market is in multiples of the leverage that you are using. So if you trade a cryptocurrency and the price maybe increases by 1%, if you are using 20x leverage, that is already 20% profit for you. And on the flip side, if you are trading a coin and the price just drops by 10%, by 1%, and you were using 20x leverage, that is already a 20% loss for you. 20% loss of your capital. Let me break it down again. The current price of Bitcoin, assuming, is $93,000, right? And then there's a sudden drop in price of 1%. 1% of $93,000 is $93. $93. That is, Bitcoin price has dropped by $93, which is 1%. I have to confirm this. I have to confirm the percentage. So $93,000 multiplied by 1%. Okay, it's going to be $930. Yes, I'm sorry about that. $930 is 1%. So let's say the price of Bitcoin drops by 1%, which is $930. So let's say $93,000 is the current price of Bitcoin, and 1% of $93 is 930. So let's say the price of Bitcoin has dropped to $92,770. That $92,070 is 1% drop. And if you were using 10x leverage, that is already 10% loss for you. If you were using 20x leverage, that is already 20% loss. And if that is 20% loss for you, just imagine if the decrease in price of Bitcoin has dropped by 5%. If the decrease in price of Bitcoin has dropped by 5%, that 5% multiplied by the 20x leverage you are using makes that 100%. 5 multiplied by 20 is 100. Makes it 100% loss. And that 100% loss now means that you have lost your initial capital, because you are now going to lose everything. And at this point, when you get to this point, this is where your account is going to be liquidated. What do we mean by liquidation? Liquidation is the time, a point in your trading this thing, that the system, or maybe any exchange that you are trading, that borrowed you this money, because you have lost so much that you have nothing to lose again. Like you've lost 100% of what you were trading with, right? They wipe out your initial, they wipe out your capital, and you've lost it. Like they wipe it out. In Forex, we call it blowing of accounts. They wipe out everything and you've lost everything. So that is the danger of trading futures. So it's usually recommended that you use a minimal leverage, maybe 10x or maybe 5x, so that in an event where the market is going in opposite direction, you are not going to lose too quick to get to a point of losing everything. That is the risk involved in trading futures. But if entering a trade, let's say for instance, you are longing Bitcoin when the price is 93k and the price is going up, and the price goes up for as much as 5% increment. 5% increment in the price of Bitcoin multiplied by maybe 20x leverage that you are using already gives you 100% profit. And that 100% profit has already doubled your capital. So on futures trading, you can double your capital within a very short period of time. And you can also lose your capital within a very short period of time. That is why you have to be extremely careful. It is very rewarding and very risky, very, very risky. Sometimes you don't even need to be an expert to lose. But for you to prevent yourself, just don't over leverage, don't over trade, and only risk what you can afford to lose. You might have, let's say your capital is like maybe $1,000 or maybe $500, and out of that you just decide to risk a little portion of that to the market and use futures to trade. And if it goes well, then you are making money, and if it goes south, you are losing just a chunk of your capital. I hope this helps, and I don't know if I've been able to cover everything, but we'll just watch this video, and if it is complicated, just rewatch it again, ask questions, do research, use ChatGPT, and trust me, with time you are going to become a crypto guru. Thank you so much for taking out the time to go through this course, and I will see you in the next one. Goodbye.